Hi, it's Matt here from City Index. We're going to take a look at my charts of the week. But first, we'll do a quick recap of what's been driving markets from last week and what to look out for on the calendar this week, alongside with some market sentiment. So maybe the biggest thing that came out of last week was the surprise rise in jobless claims figures. Now, all eyes were on the inflation report, but at the same time was the jobless report as well. And it actually spiked at its fastest pace in 2 years in 3 months. And that was very exciting to US dollar bears. Yields were lower, and I guess it was a big up for those calling for a recession. You could call that a mini stagflation because rising unemployment alongside rising inflation is the Fed's worst nightmare. However, jobless claims data can be very volatile. So the main thing to look out for this week is, do we get a repeat of that, or was it just a blip? And so if it was just a blip, maybe it doesn't really matter. However, do note the 4-week average is trending higher. So expect markets to keep a very close eye on that on Thursday alongside retail sales. The other big thing that came out was the RBNZ. They cut by 50 basis points and they indicated another 50 basis point cut in December. So when we get to inflation data on Wednesday, they really need that to be coming in softer to justify those bearish bets. Now, just flicking through the calendar, there's a lot of data this week, but a lot of it, I would argue, isn't really top tier stuff. For example, China data, there's a lot of it coming out, but we've just had huge stimulus unveiled by China. Therefore, none of that's going to get captured in this data coming out. So it's more of a data set for investors to keep an eye on because they want to assess what global growth is and where trends are going. But for a trader, I'm not really expecting any big moves from that data or any of these data sets from China this week. Now, as we get through, keep an eye on inflation data from Canada on Tuesday night at local time, because it's all about Bank of Canada rates. Are they going to be cutting rates again? Bets are in place that they probably will. So again, they'll want to be seeing soft inflation figures come out to justify those bearish bets. Otherwise, you'll be seeing a strengthening of the Canadian dollar relative to the US dollar. We've got a host of Fed speakers. Now, that always generates excitement, but the reality is that they're pretty much all sticking to the script of, or most of them are, that the Fed will probably be cutting in 25 basis point increments. So again, we've only had a couple of weeks ago, the Fed meetings, so I'm not sure we're going to get any surprises there. Locally, we've got the employment data for Australia at 11:30 on, that's my local time, my apologies, but 11:30 in Australia. Reality is employment remains pretty decent. So unless we get a curveball with some weak numbers, it doesn't really change much. So again, I don't think that's going to be much of a mover, but the one to keep an eye out on would be, where's it gone? Jobless claims and retail sales on Wednesday night. I guess really to justify the bearish reaction we saw last week, we'd want to see a rise in jobless claims alongside soft retail sales. But if we get firm retail sales, which we probably will, and jobless claim spikes turn out to be just a blip, and I think the US dollar rally could have some legs. Now, I've done a complete report here on market positioning. We'll send you a link at the end where you can read through. It's a pretty lengthy report. So I'll just quickly cover some of the basics here. Traders are increasingly long the Australian dollar. They're adding to longs and cutting shorts. That's exactly what we're going to be seeing in a bullish trend. And the fact we've seen Aussie dollar pull back to me is quite exciting, potentially looking at dips. Seasonality tends to generate bullish setups on the Aussie dollar in Q4 as well. Opposite of course is Canadian dollar. Traders are more bearish on bets of further cuts from the Bank of Canada. If we look at, I think the most interesting part for me is what's been going on with the VIX. So VIX futures have been rising for 4 weeks, and that's implied volatility of the next 30 days of the SP 500. Yet we've got the SP 500 at record highs as well. Well, we've got the November election, US election on the 5th of November, so it's less than a month away. Asset managers and large speculators are on the cusp of flipping to net long exposure. So I think what's happening here is, we've quite sensibly, investors, whilst they're bullish on the stock market, they're hedging event risk via the VIX futures contracts. It doesn't necessarily mean this is bad to see it rising, but they're obviously taking a cautious approach. And we might find the closer we get to that November election, the less risk wants to be taken. So we might even see a little bit of a pullback as traders book profits to kind of mitigate some of that risk. But do notice asset managers are also increasing their volumes to that as well. Metals is worth a look at because whilst gold is effectively trading sideways just off its record highs, we've seen a pullback on bullish exposure from large speculators and managed funds. Now, I think that it's only natural to see that kind of pullback because we haven't really seen a pullback in prices yet. But I think any dips on gold still looks decent for setups. I think we could be looking at new record highs as the year evolves. And basically where gold goes, silver tends to follow. It's a more volatile version of it. But we're seeing a very similar pattern where large speculators and managed funds are trimming their net long exposure, same with copper. But for me, it looks like potentially ones to be looking at dips on, which we'll cover shortly. As for indices, asset managers remain defiantly long SP 500 futures. They've got a lot of confidence in that stock market. Less so the Dow Jones. It had its biggest pullback on net long exposure in 9 weeks. NASDAQ is being loved again. If we spoke a couple of months ago, asset managers were not really in fan of this, but we've seen net long exposure increase for a third consecutive week for tech stocks. If we flip to the charts now, I'm going to start on the US dollar index. Now, regular readers or people who see my video, around middle of September, I was beating the drum about a rally on the US dollar. I'll be honest, it has surprised me how far it's gone, how quickly, but if the move was mature, I was of the view that markets were too aggressively pricing in big Fed cuts. And if the dollar index was refusing to go beneath the 100 level, despite a 50 basis point Fed cut, it didn't take much to remove a lot of those shorts. We've seen this spectacular rally. However, we can now see that the price action that wouldn't say toppy as such, but bulls are certainly losing a bit of steam. You've got this doji here, which perfectly respects the 200-day moving average, and price is now trapped between the 200-day average and the 200-day exponential moving average. So that alone, you could make an assumption that we're going to be for choppy trade this week. Now, that's not terribly exciting, but it's useful stuff to know because you don't want to be going into the week or a trading session expecting bigger moves than what's on offer. And when I look across the charts and I look at the calendar, and arguably there's not a lot of top tier data, we could be in a situation where we end up just taking out highs and lows, but not really moving anywhere, in which case you might be looking at lower timeframes to try and capitalize on that and not looking for any home runs. But also notice you've got the 103 handle, you've got the June low. So there's a few areas of resistance. Does that mean you want to short the dollar? Possibly on lower timeframes, but at this stage, unless we get absolute terrible numbers out on Thursday for the US, then chances are we'll probably be seeing a small pullback. So on that note, let's look at some potential setups. Now, Aussie dollar to me looks good for potential long. Timing is always key, but we've seen this pretty good, decent move lower. With respect to the 100-day exponential moving average, had a 2-day minor rally. I've already pulling back into that range. So I think that you've got a lot of volumes around these lows here, and it looks like it's trying to hold above it. You might be looking for cheeky long setups. Of course, just a reminder, this is my opinion only, not of my employers. Trade at your own risk. But for me, it does look like I think we could be looking for a cheeky move higher. But again, just want to keep in mind we're probably not looking at a particularly volatile start to the week with the lack of data. And I've drawn here the 1 week implied volatility band, so that's putting a pretty decent range. And for me, the closer we get towards that 67 mark, I think it could improve the potential risk reward for bullish setups. As for the euro, clearly it's the inverse of the US dollar index. But I do like, we've seen this particularly strong move lower. Again, we've got this potentially bullish hammer respect the 200-day exponential moving average. So there's definitely support there, and it's above that 109 handle. You've also got this high volume node from this prior consolidation. Now, from a technical perspective, that looks really interesting. However, when you start to piece together the drivers, what got us here, I'm a little bit nervous being too bullish on euro. And the reason being is we're going towards an ECB meeting on Thursday. They're expected to cut by 25 basis points. Now, ECB being ECB, they don't generally come out swinging. So I think there's a reasonable chance they might not indicate further cuts just yet. And that could see short covering on euro and potentially help it bounce. And if that's coupled with, I think, strong US data from the US, weak US data from the US to weaken the US dollar, then you might get more of a bounce. And maybe we could be looking for a move up towards the 110 area. But like the Aussie dollar, I think before those events really kick off, for me, it's looking at lows above or down to that 109 area for cheeky little setups, but not trying to get too much of a home run. And really, until we get above 110, I think there's still a chance that this market could be moving lower, especially if the ECB surprises with a dovish 25 basis point cut. Dollar Swiss is another one to keep an eye on. Although I don't know if these are the levels, so it's not necessarily a setup, but something that ING analysts pointed out, they think that every time the market comes down to 84, that the central bank, Swiss National Bank, is intervening. And you can see that's been a pretty good support level. It's been pretty solid. Now, the central SNB, central bank, they actually want a weaker franc. So if you look at what's been happening on market positioning, we actually saw an increase in bullish bets, which is against the central bank. SNB is generally not a central bank you want to be playing around with. So for me, if you want to be looking at long dollar bullish setups, I like dollar Swiss simply because it's not overextended. So perhaps we can get a movement down. There's highs here around 85, 17 to 1720, maybe down to even the 85. If we get through to a pullback, I think then I'd be more interested in looking at longs. Dollar CAD we need to discuss because you've got an important inflation report coming out. However, that is a strong move. You can't deny that is a very, very strong move on the daily chart. You've got 7 consecutive bullish days, but you've got this resistance level around 38. Now that alone is not a good enough reason for me to go short dollar CAD. Clearly we need to see strong inflation come out to get a decent pullback alongside maybe weaker US data. So for me, dollar CAD is not necessarily one to be playing around with at the moment after such an extended move, but it's one to keep an eye on because it is at a pivotal level. Historically, 138 for whatever reason has been quite an important level. So really you're taking a punt around here. But if we were, for example, to see the data was, if we were to find a bearish engulfing candle around that resistance level, then I think what a greater chance of seeing a sustained move down lower for the daily traders. Otherwise, we're really just waiting to see if we can break above 138. Dollar yen's in a similar scenario where you've got this stronger move. Now, I think eventually dollar yen is probably going to be moving higher. However, over the near term, not so. You've got 150, which is a very strong level. Theoretically, it's a very round number. But we can see the change of character here, where you've got this 1, 2, 3 move. It's a very, very strong move. But these past few days, it's almost like, not a textbook example, but it's almost like a rising wedge. You've seen a market condition where you've got hardly any overlaps at all on the daily candles, and that's a very impulsively bullish move. But then, of course, you've got lots of overlap here. So there's a lot of confusion. And again, it's another market which to me points to if you have to get involved, you're probably one looking at intraday time frames or looking at a much longer time horizon and taking a punt on the daily. But if you look at the 1 hour chart or the 4 hour chart, I would hazard a guess that I have an inkling that the market is going to try and test 150. And when dollar yen, especially when it does those tests, you generally get spikes above it. But I would look at those as opportunities to fade unless the data backs up a stronger US dollar. So for me right now, it's another watch and wait. But can we get some sort of false break above 150? And if we were to see that reversal signal around there, and then an hourly close back beneath it, then I think you've got a high probability near-term short. We're not looking for big moves here. Maybe down to 148 or these cycle lows, etc. If we look at the gold market, it's been an impressive move higher for gold. In fact, I did cover this last week in an article. I'm not a fan of trend lines by any means, but it did work this time around. So we had another test down there along with the monthly pivot. You've got this bullish outside day. It was off to the races. So clear bullish range expansion day. What I was really hoping for, but it's not happening just yet, is more of a pullback because the trend structure is clearly bullish. But you need to question this if you're bullish or whatever, or any sort of trade really, is the reward risk there? And it really depends on your time frames. From the daily chart at these levels, you're probably wanting to be betting on a break to new highs because it's kind of in between this entire move. So the reward risk isn't great. in which case you could refer to a lower time frame. And what I'm hoping to see is that we get some chop in the first half of the week. Good to see that actually it hit my 2680 target almost perfectly. What I would like to see is some choppy retracements. Then I'd be more interested in look at long setups, maybe above that 2640, 2650 area for a cheeky swing trade along the intraday time frames. On the daily, probably not really interested at these levels. And that's an important point I want to really hit home, that if you're looking at intraday trading, 90% of it is waiting around for prices to come to where you want it. It's not about just jumping in, because if you do that, you're going to get cut up and probably take a death by 1,000 cuts, essentially. Now I'm going to take a look at oil, not because I like it. I want to make a point here that oil is pretty choppy at the moment. Let me just get the correct charts up for you. So you've got here some sort of a triangle. It was a false breakout. We've come back inside. It's really messy on the weekly time frame. So if it's messy on the weekly, it's harder to capitalize on the daily. Yes, it went up for 2 weeks, but you ended up with a doji, met resistance around that trend line there. When you look at the daily, I think the most compelling thing about it over the near term is you do have this, what appears to be an impulsive bullish move. You've got a 3-day Morningstar reversal pattern, and we've pulled back in it. So I guess this is pulling back towards an area of interest around 73, 74. Maybe we could look at longs over the very near term for move back up towards 77 or 78. But what I want to highlight from the COT report is that actually we've got lower volumes from managed funds and large speculators. Net long exposure actually rose last week, but we actually got less volume. So that's not what you're going to be seeing on a bullish move on the weekly time frame. In fact, shorts were lower from both sets of traders. Yet you've got rising prices. So that's basically short covering. You've got an increase in longs from large speculators, but a decrease in longs from managed funds. So it's not the ideal scenario, and overall volume from both sets of traders is lower. So for me, I think it's probably one to just steer away from for now. But if you had to, I think it looks okay maybe on the 4-hour for a cheeky long setup. But again, I'm not looking for any home runs on that market. Another one to keep an eye on to see if we do get a signal is Aussie Yen. And it's got a pretty decent move. Now, I think we're still looking at a 3-wave retracement against this impulsive move lower. So I think upside could be limited from here, but it's still trying to fill some of its liquidity gaps left on this very aggressive move lower. You've got this hanging man candle last week, so again, it's a little bit choppy. Sorry, hangman week. It's also oscillating. It's trying to build base above 100, so that's quite constructive. It's above the 200-day average and the exponential moving average as well. So I guess, again, on the lower time frames, any pullbacks towards that could be interesting for a near-term long. But for it to break above these cycle highs, we're probably going to be seeing an extended rally on Wall Street. And let's just quickly look at the SP 500 futures market. And these moves to me are a nightmare because I'm more of a mean reversion person. So to see markets at a record high, I always feel like I'm chasing the move. So I'd always want to see a pullback on this kind of thing. You can't deny that as a solid uptrend. And as we saw in the market positioning previously, the asset managers are firmly behind this market, but they're also hedging event risk via the VIX, which makes sense. Nothing wrong with that. So this is in my dip category, but again, you probably want to be seeing pullbacks to get in at more favorable prices from there. SPI 200, which is the Australian or ASX 200 futures market, is tracked Wall Street higher. So it's been out the gates today. However, will it simply break to a record high or not? You've got the all-time high there at 8,333. This requires a little bit of patience here, and this might sound a little bit lazy, but you've got some very choppy price action. It's basically moving sideways. We can see what happened on the 30th of September, where it reached a record high. The very next day sold off. So maybe we'll close higher today. I thinking when you get to that 8,300 level, it's one to be considering shorts to trade back within that range. Clearly the risk is here that it will continue to track Wall Street higher and you just get stopped out. That's always going to be a risk. But because we've got this multi-week range where it has struggled to hold on to highs, that I'd really be looking for maybe a safe way of doing it is for, if it was to say a daily close beneath the record high with an intraday spike higher, I'd be more interested in looking at shorts maybe the following day or later in the week. If you get a daily close above that record high, it could indicate further gain. So you probably don't want to be shorting it. So again, you need to sort of assess this one, use a bit of common sense, don't just jump in. But as things stand at the moment, it's on my watch list for potential shorts, but the signal's not there quite yet. So I hope that was useful. Any questions, drop it into the chat and we'll try and get back to you. And I wish you best of luck with your trading.